let's talk about all that money that's flowing into insurers. We've had a sort of a 10% kick up from the estimated 50 billion a year to 55 billion a year. That's a lot of money, a lot of zeros. It's all got to go somewhere. Where is it going to get invested, Gareth?
So that's my job and my team's job, and similar teams exist in other insurance companies. So if we go back to when I started my career, so 25 years ago, this was pretty boring. Insurance companies generally invested in government bonds to back these sorts of liabilities. That was sufficient. They would take the coupons on the government bonds, invest some in cash, and that would be enough. And then, as in the early days of my career, then those government bonds started to be replaced by corporate bonds as insurance companies sought higher returns in their portfolios. So that was all fine until the financial crisis. And the financial crisis had found that we needed a new sort of company to replace the banks. So banks previously were the lenders. They were the lenders to the private markets in particular. And so what we have seen over the last 15 years or so is we've seen insurance companies get much better at underwriting, harder to price, harder to value, harder to assess assets. And so we've become much more focused on private markets and private credit in particular. So your typical investment portfolio over the last 15 years has grown to be, let's call it 50% private assets and 50% public assets, where the 50% public assets have really been corporate bonds and the 50% private assets have been a wide range of different asset types. And so what does that mean today? Well, there's two things that have changed in today's market.
Is there a concern that because you are a pretty constrained investor in that basically it's just fixed income, baby, in one form or another in terms of insurers, is there a concern that if we've got all of this cash flowing in year by year, that even, say, sovereigns or global credit or even private markets, which DC funds are also being encouraged to invest in, and I know there's been some criticism recently of private credit, that you're kind of all going to end up chasing the same asset and pushing prices out of beyond value and creating bubbles? Is that something that you think about as somebody who's managing such a large balance sheet?